Look at your screen. Silver just tagged $83.62, and then it got smashed back down to $72.02 in the same session, down 5.8% on the day, in the quietest week of the year, when half the desks are empty, half the risk managers are out of office, and the market is supposed to be asleep. That is not a normal market. That is the sound of a spring being wound tighter and tighter for months, and then finally snapping. And if you have been watching these markets long enough, you know what comes next. The headlines will try to make it feel tidy, orderly, rational. They will use soft words: profit-taking, healthy correction, year-end rebalancing. But the plumbing does not speak in soft words. The plumbing speaks in numbers. And today the numbers were screaming. Silver did not gently climb. It detonated. It hit a record at $83.62, and then it reversed like the market chose violence. It did not drift lower. It fell into an air pocket. And an air pocket is not a dip, it is a vacuum. There is no liquidity between here and the next level, so price does not step down, it drops through the floor. And then, right on cue, the exchange pulled the lever that always appears when the price starts behaving like it has a mind of its own. Margins. CME raised margin requirements again. Silver margins are up 20%. Gold is up 15%. Platinum is up 24%. Palladium is up 21%. And if you are new to this, you might think that is just some boring technical footnote. It is not. It is the hidden interest rate of the futures market. It is the toll gate. It is the choke point. It is how the system controls who gets to stay in the game when the price starts running away from the narrative. They tried to cap it with paper. They failed. They tried to calm it with commentary. They failed again. So they tightened the collar. Margin is the collar. And when you tighten it fast enough, somebody starts to suffocate. Now ask yourself a simple question. If this is just a normal correction, why did the exchange feel the need to hike margins again today? Because this is not a gentle market. This is not a healthy rally. This is a battlefield. And the side with the metal wins. You saw the same violence in gold. Gold printed a record at $4,497.82, and then it backed off to around $4,326.55. Another whip, another slap. Another reminder that when these metals move, they do not move like your favorite tech stock. They move like a stress test. And this is the part where I need you to stop thinking like a retail trader for a moment and start thinking like a system. Because the system is telling you something. Loudly. A market does not behave like this when everything is fine. A market behaves like this when positioning is extreme, when liquidity is thin, and when the difference between paper claims and physical reality is getting too large to ignore. $72 is not just a number, it is a fortress, and the battering ram is already moving. And $80 is not just a headline, it is a message. It is the market whispering to you, through pure price action, that something underneath is breaking. Now zoom out with me. This year, the dollar index was down about 9.4%. The euro was up about 13.5% against the dollar. The pound was up about 11.3%. That is not just a chart. That is the background radiation of currency debasement. That is the slow leak in the hull that everybody pretends is not there because the music is still playing on deck. And while the dollar bleeds, metals do what metals do. They become the mirror. They reflect the truth. They are the lie detector test for a monetary system built on infinite promises. So the mainstream will say, well, of course gold and silver went up. The dollar was weak. The Fed might cut. The market is pricing something. Sure. That is the sanitized version. That is the polite version. But the real story is always in the structure. Always in the plumbing. Always in the flows. Because the West has spent decades pretending it sets the price. London sets the fix. New York trades the contracts. And the headlines tell you that is the market. But in Shanghai, they do not trade a story. In Shanghai, they trade bars. In New York, they trade claims. In Shanghai, they trade metal that can burn your hand. And today, right in the middle of this chaos, you got a number that should make the hair on the back of your neck stand up. The Shanghai Premium, in dollar terms, was reported as up more than 300% since 2024, and up 26% in 2025. Read that again. More than 300% since 2024. That is not a rounding error. That is not a curiosity. That is a magnet. That is a vacuum. That is the East pulling on the price like gravity, and the West trying to hold the line with paper. And when the East pays more than the West, that spread is not a fun trivia fact for metal nerds. It is a siphon. It sucks every available ounce out of Western vaults and into Eastern warehouses, one shipment at a time, until the West wakes up one day and realizes it is still setting the benchmark, but it no longer owns the metal. If you want to understand how a monetary regime ends, it does not end with a speech. It ends with flows. Now, the headlines will try to frame today as a year-end event, a little profit-taking, a little cleanup, and yes, even some commodity pages are already pushing that line. Silver fell more than 5% to around $72 after briefly pushing above 80, and they'll call it profit-taking into year-end. But profit-taking is what you say when you want to avoid saying liquidation, because liquidation implies force. Liquidation implies someone did not want to sell, but had to. And if you have watched enough crises, you know the pattern. Price goes vertical, volatility spikes, the exchange hikes margins, and then the forced selling starts, not because the story changed, but because the collateral rules did. This is not speculation. This is collateral management. This is not a dip. This is a margin kill zone. And you can see the same story echoed across the broader market tape. The VIX was up, around 14.86, about 3.7% on the day in the live snapshot. Not a panic number, not a crash number, but direction matters. The VIX is a smoke alarm. It is not supposed to be screaming when the fire is already raging. It is supposed to chirp when something starts smoldering behind the wall. And metals are the smoke. Now look at rates. The US 10-year yield ended the year around 4.35%, up about 21 basis points in 2025. Meanwhile, the German 10-year yield was down about 44 basis points over the year. That is a divergence. That is a split screen. That is two different worlds trying to coexist. And what happens when the world splits? Stress moves into the seams. The seams are where the trades live. The seams are where the leverage lives. The seams are where the derivatives sit, quietly, like a pile of dry leaves waiting for a spark. And today, that spark was silver. Now, I want you to imagine something. Imagine you are a junior trader on a quiet year-end desk. Your boss is skiing. The senior guys are on vacation. The book is still there, though. The positions are still there. The risk does not go on holiday. Silver starts moving. It pushes through levels that were supposed to hold. It starts climbing like a meme stock, except this is not a meme. It is a monetary metal and an industrial metal at the same time. Your screens start flashing. The phone starts ringing. And then you get the notice. Margins are going up again. And suddenly you are not managing a trade. You are managing survival. Because when margins go up 20%, the question is not, do you like silver? The question is, do you have cash? Do you have collateral? Do you have a balance sheet that can withstand the exchange tightening the noose? And that is where the weak hands get shaken out. Not because they stopped believing, but because they ran out of oxygen. This is why I keep telling you over and over that the futures market is not a pure price discovery mechanism. It is a collateral machine. It is a leverage machine. It is a system designed to let institutions manage exposure without moving physical metal most of the time. Most of the time. But when the physical world starts pulling harder, when the East keeps paying a premium, when the dollar weakens, when investors run to metals, and when industrial demand keeps marching forward, the paper world has to react. And when it reacts, it reaches for the only tools it has. More paper, more rules, more margin. So the exchange will say it is prudence, risk management, stability. But from where you are sitting, it looks like a gate being closed. And when gates close in a market, it is never because everything is calm. It is because something is trying to run. Now let us talk about the elephant in the room. The thing that mainstream coverage will always whisper around, never stare at directly. Silver is not just a shiny rock. Silver is an industrial input. It is the hidden blood in the veins of modern life. Solar, EVs, electronics, data centers, defense systems, medical devices, everything that needs conductivity, reliability, and performance. And here's what that means in plain language. When silver goes vertical, it is not just investors getting excited. It is procurement managers getting nervous. It is supply chains getting recalculated. It is budgets getting blown. It is contracts getting renegotiated. And those people do not buy because they are bullish. They buy because they cannot afford to be wrong. A trader can take a loss and move on. A manufacturer who cannot source a critical input can lose production, lose market share, lose credibility, lose their job. So if you want to understand why silver can behave like a cornered animal, you have to understand that it sits at the intersection of fear and necessity. Gold is fear. Gold is the vote of no confidence. Silver is fear plus necessity. And that is why when it moves, it can move like a stampede. Now let us talk about the psychological trap. Because I know what your brain is doing right now. Your brain is hearing $72 and thinking, wow, it just dropped. Maybe the top is in. Your brain is hearing 83 and thinking, wow, that was the blow-off. Maybe it is over. That whisper you are hearing, that is not wisdom. That is conditioning. That whisper is the system teaching you to sell your lifeboat back to the Titanic. Because here is what the year told you. Silver was reported as nearly up 160% in 2025, with gold up about 59%. Think about that. This is not some slow grind. This is not a sleepy inflation hedge. This is repricing. And when a market reprices, it does not do it smoothly. It does it violently. It does it in waves. It does it with breakouts and snapbacks. It does it with headlines that try to shame you into believing the move was irrational. They will tell you it is froth. They will tell you it is mania. They will tell you it is a bubble. But they never ask the right question. If it is a bubble, what is it bubbling against? A currency that was down 9.4% on the year. A debt system that requires lower rates to survive, but cannot cut too fast without igniting inflation again. A world where the East is paying a premium and the West is writing contracts. So no, this is not a clean bubble story. This is a trust story. Now look at Europe. The DAX was up about 18.5% in 2025, hitting records. The StoXX 600 up about 8.2%. The FTSE 100 up about 7.5%. Risk assets did well. Everybody is smiling. Champagne, year-end celebrations. And in the middle of that party, silver is moving like a fire alarm. That contrast matters. Because it tells you something deeper. It tells you that the system can look healthy on the surface, while stress builds underneath. Equity indices can float on liquidity and optimism, while the hard asset that has served as money for thousands of years starts screaming that the foundation is eroding. This is not either or. This is both at once. That is what late cycle looks like. That is what a regime shift looks like. Everything can be up, until suddenly everything is up for the wrong reason. Now let us go into the pipes for a moment, because this is where most people get lost. The paper market, the futures market, is enormous relative to the physical market. Contracts can be created. Exposure can be traded. Leverage can be stacked. Options can be written on top of futures, which are written on top of underlying assumptions about supply and demand. And in normal times, the physical market is the anchor. It is the quiet reality underneath. But when reality starts moving, when physical demand tightens, when flows shift east, when premiums widen, that anchor starts pulling. The paper market can ignore it for a while. It can dampen it. It can cap it. It can smash it. But it cannot cancel it. Because at some point, somebody wants delivery. At some point, somebody wants the bar. And when that moment comes, the system's response is always the same. Increase the cost of holding the paper. Increase margin. Force positions to shrink. Make the game smaller so it is easier to control. Today you saw that play. Now I am not telling you that the exchange is evil in a comic book sense. I am telling you it is structural. The system is designed to preserve itself. And preserving itself means preventing a disorderly run. A run on collateral. A run on deliverable supply. A run on trust. So the villains in this story are not always a person. Sometimes the villain is the mechanism. The cartel is not a secret meeting in a smoke-filled room. Sometimes it is just aligned incentives, boring, bureaucratic, and ruthless. Banks want stability because instability kills leverage. Exchanges want stability because instability kills participation. Regulators want stability because instability kills careers. And the East wants metal because metal is stability. So you have two worlds. The West managing the story, the East managing the flow. And when those worlds collide, the price chart is where the collision becomes visible. Now add one more layer: year-end funding. Most people do not look here because it is not sexy. But this is where crises are born. Quietly, in the gutters. The New York Fed overnight reverse repo take-up was around $12.605 billion for the most recent operation date visible, December 30th, 2025. That is not the gigantic number it once was. But do not get distracted by size alone. What matters is that money is still moving through facilities. Cash is still parking. Collateral is still being managed. And year-end is when the system is most sensitive. Balance sheets get dressed. Ratios get managed. Liquidity thins. Dealers step back. The pool gets shallow. Remember the water metaphor. In a deep pool, you can cannonball and barely move the surface. In a bathtub, one jump sends water over the edge. Right now, silver is a bathtub. So when a large order hits, when an options position flips, when a margin hike forces a liquidation, you do not get a gentle move. You get a splash. You get a flood. You get chaos. That is what you watch today. Now here's the part that matters for you, the prepared individual, the one who does not want to be the last person to understand. Today was not just a spike, it was a preview. It was the market showing you the shape of the next phase. Because once a metal starts making records, the system changes its posture. Participants change their behavior. Volatility becomes the baseline. The headlines become more aggressive. The counter-narratives get louder. They will tell you it is over. They will tell you to take profits. They will tell you it is too late. They will tell you the smart money is leaving. And then, when you blink, the price moves again, and they act surprised. They tried to cap it at 65. They failed. They tried again at 67. They failed again. And today, they are not in control anymore. The price is. Now let me ask you a question that you should sit with. If silver can hit 83 and then drop to 72 in a single session, what does that tell you about the fragility of the paper structure? Because a healthy market does not need constant intervention by margin policy. A healthy market does not whip like this unless someone is trapped. So who is trapped? The shorts are always the first suspect. And yes, when price moves like this, shorts feel like they are in a crowded theater. The exit sign gets smaller with every tick higher, and when margins rise, the crowd panics. They shove, they stampede, somebody falls. But there is another trap here too, the narrative trap. The West has built a narrative for decades that gold is a barbarous relic and silver is a hobby. That is the story. That is the script. And silver is refusing to play the role the banks wrote for it. Because when the world starts distrusting currency, it looks for anchors. And when industry needs a metal, it looks for supply. And when the East is willing to pay a premium, it looks for flow. You cannot paper over all three forever. Now, do not misunderstand me. I am not telling you tomorrow is the end of the world. I am telling you the system is in a phase where stress expresses itself in sudden, violent repricings. And those repricings are signals. They are warnings. They are glimpses behind the curtain. When gold hits 4,497 and then backs off, that is not the end of the story. That is the beginning of the market testing higher ground. When silver hits 83 and then gets slammed to 72, that is not the market dying. That is the market learning where the landmines are. That is the market discovering where the margin kill zone sits, where the paper caps are, where the next fortress lies. And fortresses matter, because when a price holds above a fortress long enough, the fortress falls. And when the fortress falls, you are in blue sky. No resistance, no reference points, just air. And air is where the violent moves live. Now let us bring the East versus West layer back, because this is the layer that most people will still refuse to see until it is too late. For 40 years, the West has had pricing power because it had credibility, it had markets, it had liquidity, and it had metal. But pricing power drifts. It drifts toward whoever has the real bid. It drifts toward whoever is willing to pay in cash and take delivery. It drifts toward whoever is building the factories, the grids, the supply chains. And today you were reminded that the Shanghai Premium is not a footnote. It is evidence. It is the fingerprint of an emerging split. It is the proof that there are two prices trying to exist for the same asset. One price for paper, one price for metal, and you can live in that split for a while. Markets can tolerate weirdness. They can tolerate stress. They can tolerate distortions. Until they cannot. And when they cannot, the adjustment is never gentle. It is violent. It is fast. It is humiliating for anyone who believed the old script. So what does a prepared person do with a day like this? You do not treat it like entertainment. You treat it like reconnaissance. You watch how the system reacts. You watch the levers. You watch the language. You watch the margin hikes. You watch the volatility. You watch the dollar. You watch the yields. You watch the premium signals from the East. Because this is the roadmap. The roadmap is not a prediction. It is a pattern. And the pattern is telling you that the metal is becoming the battlefield again. The market is not behaving like a calm asset class. It is behaving like a contested resource. And contested resources do not reprice politely. They reprice under pressure. They reprice in bursts. They reprice when the wrong person is overleveraged at the wrong time. They reprice when liquidity is thin. They reprice when the exchange tightens margin and calls it stability. Now I want to end with a verdict, because this is the part the headlines will never give you. The system can print contracts. The system can print narratives. The system can print excuses. But it cannot print metal. The East can print purchase orders. The West can print paper claims. Only one of those ends in a bar moving from one vault to another. And that is why days like today matter. Because today was not just a price spike. It was a message. It was the market showing you, in the harshest possible way, that the era of calm, managed metal prices is fading. The fortress lines are being tested. The plumbing is being stressed. The spread between paper and physical is becoming harder to ignore. And when the history books talk about the end of this system, they will not show you the headlines. They will show you the price screen on a quiet year-end day when silver hit 83 and then fell into a $72 air pocket and the exchange panicked and hiked margins again. Because that is what a regime shift looks like. Not a bang in the newspapers, a crack in the pipes,